In the Wealth Report, we look at the risks and opportunities for wealth creation, wealth growth, and wealth preservation. Unexpectedly, the ongoing disruption from COVID was the biggest factor concerning individuals in 2021. Today, we want to explore some of the most hotly discussed areas of this. How Delta continues to disrupt supply chains and what is happening to inflation and how this relates to property. We also sparked the conversation on the future of the city, talking about how cities rise, fall, and rise again. Since the report launched, we have seen many cities spring back into life, with office occupancy on the rise, sports and entertainment venues at full capacity, and people back on public transportation. But this picture is not global, so we want to uncover some of the nuances. To do so, I have an excellent panel joining me today. The first is David Balin, Wealth Report contributor, Chief Investment Officer and Global Head of Investments for Citi Global Wealth. We have Ian Mulcahy, who is Director of Cities and Principal at Gensler, and Knight Frank's own Head of Research in Asia Pacific, Christine Lee. So welcome to all my panelists, and thank you for joining me today. Something that is undeniably in all investors' minds at the moment and all over the headlines is inflation. We've seen energy prices spiking across the world, particularly in Europe, and we've seen blackouts across mainland China. The ongoing supply chain issues are something we see every day in the newspapers. So David, I wanted to start with you. Could you let us know what your thoughts are on whether this is a transitory shock or something investors should be worried about more going into next year? And how real is the threat of stagflation to the economic outlook and in 2022?
Well, first of all, thank you, Flora, for that great introduction. And you've hit upon, I think, a central question that everybody has right now, which is what is really going on with inflation. So I think we have to put this in the context of what is actually going on in the global economy right now. As we come out of the pandemic, what is really taking place is that people are buying more goods than they normally would and fewer services than they normally would as a result of the pandemic, essentially. And that is causing an extraordinary amount of demand for the production of things. And as the production of things is going up, and we're talking about, by the way, a 20% above normal level of that globally, we're also seeing some labor shortages take place across the globe. And those labor shortages are really sourced by a couple of different things. One is an actual dislocation of labor. It's actually moved geographically, and it's moved that way because of the pandemic itself and the fact that people have initially left cities, to your point earlier, and are coming back to them now. But more importantly, they also have had to find other employment during the pandemic. So a person who gave up their job in shipping or in trucking has found other employment and now has to decide whether or not to come back. And that shortage is global. I was at a meeting in Europe where I actually talked to people, everything from mining to appliance manufacturing, everything from Poland to Detroit, and everywhere we see this labor shortage. So when you combine the excess demand for goods and a labor shortage, as well as a huge dislocation in the supply chain itself, in other words, the number of ships and where they're located, you end up in a circumstance where you actually have inflation due to all of those factors taking place at the same time. Now, what we worry about, sort of from an economic standpoint, is what's called sustained inflation. The probability that demand will continue to outstrip supply for years on end, which we do not see taking place. And so your natural question is, why don't we see that taking place? Let's take a look around the world at the major economies. First of all, the US is actually slowing its stimulus. Even the passage of the new bill will actually be an 8-year spend. Second of all, China, through a variety of actions, both internal and external, is having slower economic growth. And lastly, we're actually going to see the return of services, as I just mentioned, all of which will cool demand for goods. And as that takes place, you'll have a normalization of the supply chain and a normalization of the global economy, causing inflation to go to an ambient rate. The ambient rate of inflation will be higher now than it was for the previous decade, but it will no longer be 5% per year every year to come. And that's what the bond market is telling you when rates are where they are. And finally, we have to take a look at what the Federal Reserve is doing. They've been buying excess bonds, right, and creating an extraordinary amount of liquidity in the market. That's going to stop over the next year too. And investors are going to have to put their money into financial assets rather than just think about, what they're going to do for goods. And as they invest more in financial assets, that will also cool the general demand for goods. So all of this suggests that this is transitory, But we are seeing some pretty extraordinary things. When we take a look at energy shortages, that was unanticipated. The inability to get semiconductors, that was unanticipated. And all of this, I think, speaks to an unusual, post-pandemic world that we've entered into. But again, we think that's probably a year from now or less to resolve.
Yeah, I think that's it. It's just a lot of unexpected things coming out of the pandemic. But the pandemic itself was unexpected, so we can't look back in history. And I think we're entering that more volatile inflation period coming up. But we spoke a few months ago on our podcast about the timeline for the Federal Reserve on tapering and the interest rate rises. Given the recent meetings, do you see interest rates moving sooner in the US or outside? I know we've seen Norway, South Korea, New Zealand all raising rates, and the Bank of England taking a very hawkish approach. So what do you see as the forecast for rates over the next year or so?
Yeah, so Jerome Powell has made it very clear that they are going to have, a withdrawal of the bond buying programs in the U.S. first. That looks to take a minimum of 12 months. And when you take a look at the forward futures curve right now, as we're sitting today, it prices in 4 or 5 rate hikes after that, taking place into 2023. And remember, those are all rate hikes at the short end of the curve. So to answer your question directly, we expect rates to end up settling around 2% for the 10-year bond, which is not that much higher than it is now. It's about 40 basis points higher, with obviously a much flatter yield curve at that time. This is a very, very a mild increase in rates. And it speaks to the fact that if you think about what's going on in Europe broadly, what's going on in Japan, where rates are negative, even having positive rates of 2% in the US would be a significant delta to that, and would speak to the fact that I think the US and the dollar will be an attractive place to be if you want to earn any yield at all. From a real estate perspective, of course, this is a very benign environment. And that speaks to the idea that, real estate will be a good asset class, and that it could also be an inflation hedge to the extent that there is inflation in certain parts of the economy. And if I could just address that, as an interesting point for the viewers obviously watching, certain demand for assets, for example, digital infrastructure space, last mile delivery space, warehousing space, what I would call small offices, in other words, smaller offices, right? A more flexible office space, all of which is going to see an increase in demand in this environment. Where general spaces, for example, what I would describe as Class A typical office space, actually could be under stress in a lot of major cities, simply because it hasn't been adapted for the kind of flexible use that this post-pandemic period will call upon. And what I'm referring to specifically is the idea that for many, many businesses, the need to work 5 days a week in an office has been disproven. And so the question is, what's the right balance? And that balance will obviously affect core real estate demand, all across the globe, and especially in developed markets.
Yeah, very much so, and lots to think about. And we're going to come back to sort of that work piece in just a moment with Ian. But I'm going to bring in Christine here. And what does the prospect of higher rates mean for investors across the Asia-Pacific region in particular? As I mentioned, we've already seen New Zealand raise rates. But what's the sentiment there among investors?
Thanks, Flora. I think the cause of the recent spike of the Treasury yields in the early part of the year were really driven by investors' inflationary expectation. So given the pace of the economic pickup and the rising commodity prices, have feared that these low rates set by the Fed is unlikely to be sustainable. However, yields have also fallen back since the central banks have largely stood by their pledges to remain accommodative. And I believe such knee-jerk reactions is also unlikely to occur again. But still, bond yields is likely to rise as economic activities normalizes. However, I think the reflationary trade can be consistent with the synchronized global recovery and the return of the inflationary pressures. In order for that, it's just inevitable trade-off of recovery. So given this backdrop, I think investments into real estate will no doubt benefit from the revival of the economy, and the financing environment have also remained quite conducive. So real estate investors have a longer horizon and also tend to be driven by other motivational factors. So this will especially true in the region, which will continue to benefit from the demographic reinforce as well as sustainable urbanization. Moreover, real estate asset classes continue to be one of the best hedged against inflation. So as such, I think real estate would continue to remain an attractive asset class.
Yeah, definitely. It seems to be a big global theme there picked on by both you and David. I want to also pick on something that is a dominant headline over the last month particularly, and that's been the debt levels in Chinese firms and notably Evergrande. Is this causing concerns amongst Asian ultra-high net worths and investors, and is this playing into property markets?
Yeah, very good question. I think currently the systematic risk to China is actually pretty much contained. So the Chinese banks are quite well capitalized to withstand any shocks arising from a collapse of developers of that sort. But the size of Evergrande's borrowings are also unlikely to overwhelm the financing system. So Chinese central banks have also promised to protect the consumers' housing loan exposures and has also injected more capital into the banking system since August. That's a clear indication that authorities will manage the impact of this property market on its economy and will move to prevent this contagion as required. So while there will be some volatility, it is not expected to turn into another Lehman crisis. And the risk, however, will be more weighted towards the bond issuance, which means missed payments, which has already defaulted. But it won't actually result in heavy losses amongst the investors. But I do expect some Asia high net worth individuals to have some losses, although their portfolios are actually sufficiently well diversified to protect them from this fallout.
Yeah, lots to think about there. And I just want to pick now back on the sort of cities and built environment and bring Ian in here, because there's been so much rhetoric around the end of cities and the 15-minute city and roaring back into life. So what, if anything, do you think will be the lasting impact of COVID in cities, particularly the built environment?
Yeah, I think this has been such an extraordinary time, really. And I think for people thinking about cities, planning, designing cities, you never have a chance to test these things in the way that the pandemic's effectively tested something that we could probably never have imagined. But I think we'd for many years seen certain trends taking place, changes in the way we engage with a retail experience, changes in the way we were working, that process of the disaggregation of the workplace and people choosing to work more remotely, people shopping online, people even engaging in entertainment more online. And we could see all those trends, but actually most people's day-to-day lives really carried on in much the same way they had done for several generations, or certainly since the war. The idea that I commute to work and I sit in a building working from 9 till 5 or 9 till 6, and then I commute home again. And across most of the Western world, we're moving millions of people from their home life to their work life, and then back again in the evening. And I think people were already using technology to test the limits of that. Well, do I need to do that every day? Can I work further afield? Can I work a few days a week in the office and a few days somewhere else? What the pandemic did was force everyone pretty well to shift, certainly in professional services world, to shift from an office environment to a home environment with very little grey area in between. It wasn't a hybrid situation, it was a total shift for most organizations. What we're now going through is the hybrid, where some people have gravitated back, some people haven't, some people have made permanent lifestyle changes, and you see that reflected in the housing market in the most extraordinary way. House prices rising outside beyond London, and prices really soft in London. People cashing in, taking advantage of low interest rates, taking advantage of furlough and even redundancy, and saying, actually, I'm going to move forever out of this city, and I'm going to work in a different way and live in a different way. I suppose the question now, which everyone's trying to understand, is as we go through hybrid, will it go back to the old? It seems unlikely. It seems most organizations are trying to adapt to hybrid, even some welcoming hybrid and some more reticent. But I definitely see that connection between the size of a business, its headcount, and the amount of real estate it has in the center of the city is broken probably forever. And I think businesses are quite comfortable now to hire headcount, irrespective of whether they've got offices to house them in. And I think now people, perhaps because there's a shortage of people to do the work, people are engaged quite actively in hiring people further and further afield from their core office community. So I definitely think there's a permanent change in there. How great that permanent change is, it's difficult to yet be precise about. You certainly see, even though businesses are kind of returning to normal, the patronage on the metro system in London is 50% of what it was pre-pandemic. So you can clearly see in the numbers that less people are traveling into the city. But the role of the city doesn't disappear. And I think all the evidence is suggesting that the role of the city is still very much alive, because the physical interaction becomes the premium experience. The need to collaborate, the need to meet, the need to exchange ideas, it doesn't go away in this virtual or semi-virtual world, and actually becomes a more special, important thing perhaps. It's just the question about whether you need to do it every single day. And I think the role of the city as the easiest place for people to meet, to come together, to collaborate and socialize, and actually probably the most attractive place for many people to do that with all the choices that offers, I think will make the cities endure. But they will have to adapt. I talk about the fact that maybe the CBD in the old construct is dead, but maybe the CBD becomes the CCD. Maybe it becomes that sort of central cultural district rather than that central business district, and that actually people still need to come together and meet. And it's still a place for a business to say, I also need a place where people come together and collaborate and meet. But I don't need everyone sitting there every day checking their emails.
Yeah, so much to think about there. And as you say, the cities are very much still that melting pot of culture and vibrancy and lifestyles. But do you think it will change the way that we look at developments potentially in the future?
I think it already is changing the way we're looking at developments. I think any smart developers going, well, actually, we don't need giant offices with rows and rows of desks with people doing repetitive tasks necessarily. But what we do need is environments where actually people, want to be attracted to work for an organization. So the shop window feel to a business, a place where businesses engage with their clients, and show what they're capable of and interact with clients, a place where staff can come together and learn from one another, a place which has or embodies the spirit, the brand of an organization. I think all of those become very, very important. But I do think location becomes absolutely premium. So actually, if I have a disaggregated workforce scattered around a region, around a country, or even across multiple continents, which was already a trend that you were beginning to see, and that's clearly accelerated, they need to be able to get to that point, even if it's occasionally, even if it's once a year, in a convenient way. So I think the old tradition of headquarters being kind of jostling for position in the center of a city becomes even more marked. And I think the more peripheral locations that perhaps aren't as well located, aren't as well connected, and actually don't have the broader offer of what I would call the CCD, maybe they're more vulnerable. But the prime places which have the best communications and the best local offer clearly are going to succeed. I also think there's a global context to this as well. So I think rather than a regional headquarters or a headquarters that just serves one city or one country. Actually, that notion of actually that coming together of people, that collaboration of people becomes really significant from a global sense, that maybe I don't need an office in every city, but I do need one in 2 or 3 key cities in the world.
It's looking at it in that strategic decision-making capability. And Christine, I know the picture is nuanced, and perhaps cities in Asia were some of the fastest to see the bounce back. Our Global Buyers Survey and in the Wealth Report, we point to less desire to move out of cities, particularly amongst Asian ultra-high net worths. What are you seeing in terms of the region of, in terms of urban living, and has the model changed, or are we going back to 2019? And how is this playing into the property markets there?
Yeah, very good question. I think COVID-19 has certainly not killed the cities, particularly in Asia. So in our 2021 Global Buyers Survey, actually 44% of the Asian buyers are still looking at city locations for their next move, compared to, say, suburban, which is only 35%, or rural or villages, which only occupies 3%. And this pandemic has also put some health and wellness into the forefront of younger generations' consciousness when they are selecting new homes, and location factors such as good air quality and the proximity to green spaces, as well as access to good healthcare, actually are the top factors for them when they choose where to live in the city after COVID restrictions end. So you can see the good air quality, actually 76% of the respondents wanted this factor, and 72% wanted the proximity to green spaces, whereas good health care had about 71% of the respondents choosing that. And I think the allure of a more luxurious lifestyle is also a draw and itself to the region's next generation buyers. That's very important, and they will be able to access to quite a lot of amenities such as restaurants, gyms, entertainment, sports, retail, as well as cultural amenities. I think the region currently remains very much in the middle of this long-term urbanization trend, and also with the current rate of urban dwellers to its own population, it's also just about halfway mark. And there is still a lot of room to make up. And this means that this continued growth in the region's urban centers will continue because of the demand growth for urban living.
Yeah, there's certainly some really interesting points. And I'm going to sort of pick on some of the themes you were looking at there, and that's sort of sustainability and, ESG. It's obviously a big topic. And actually, David, I want to go back to you, because something we pointed to in the Wealth Report last year was the regreening of the planet as one of the biggest opportunities for wealth creation, growth and preservation. And I know we've got COP26 happening in just a week or so. So how are investors factoring this in? And, there's a lot of talk about greenwashing in the market and how things are labeled as ESG or green. So what is your advice to investors here, and how are you shaping investments around this particularly big trend?
Well, Flora, we have to look at the context for all of this. So what we see are two distinct movements taking place. There is leadership in Europe on the idea of climate and management of climate change as a major issue by governments. In the United States, that's less clear. And one of the questions, in fact, that this week is going to be addressed is really whether President Biden is going to organize the administrative groups within the government to focus on climate, because he's been unable to do so in the legislative process. To the extent that he manages to tie climate issues to the regulation of financial markets, which I think is the most likely outcome, and we'll learn more of that immediately, then it will have a direct and linear impact on investors and on investing. When we take a look to the corporate side of the world, regardless of what governments are doing, we're seeing tremendous change in standards and practices, which is really what's behind this ESG movement, is that corporations are making decisions to change their behavior. Now, the question is what's causing them to do so, right? It's not just, their own generosity, but actually the movement among shareholders and among those that are organizing shareholders to force that change. So think about what that means, which is it's an extra governmental activity that's happening, meaning that the shareholders are voting and they're causing change to take place in the corporate boardrooms, not necessarily directly due to governments doing so. This combination of government action and independent action that is affecting corporations is changing the actual landscape for us as investors. So now to address exactly your question, which is, well, how do we think about this concept of greenwashing or whatever? I think we have to ignore that to some degree, right? Because the labeling of something as ESG in my job is really quite irrelevant, right? What's relevant is that we analyze each individual company and each industry and see whether or not it has the resources necessary, right, to make the transitions to greener technologies or less impact on the environment, and whether or not they're actually doing so or they're not really doing so. And as it turns out, the research so far indicates that those companies that are managing through this change process, right, are actually forcing change within their organizations, are actually driving cultural changes even beyond ESG, meaning that by dealing with the issues, right, of diversity, for example, or environmental impact, or how the companies are regulated or self-regulate, you actually see that those are driving better economic outcomes for those companies, because in fact, having to manage that change causes them to evolve, causes them to embed technology into their business in a different way, to gather data and utilize data differently. And all of this is very encouraging, I think, for the economic marketplace for certain stocks that are obviously there. And then lastly, and I know I've gone on a bit long on this, the fact is, of course, there are many, many companies providing the technologies, right, providing the data gathering systems, monitoring what's going on in the world. And to us, that is a direct, what we call unstoppable trend. In other words, where you can actually invest in companies whose business is ESG. And for us, that that is going to be something that for the next 20 or 30 years is going to be a pretty good place to be. So a lot for us to think about, but from an investor's point of view, the key is, can we identify the people doing the research to build stronger portfolios by identifying the characteristics I've outlined.
Yeah, I think that's a really important point that I'm just going to pick on, is that it's not just the labeling of things, it's actually going deeper and really assessing that, which, as you say, are those sort of data providers. There are now companies doing specifically that. Ian, I just want to ask you about the environmental agenda and how it's shaping cities. How do you think that they will adapt to this? Because obviously the built environment is a large amount of carbon emissions. So it's one of the biggest opportunities and also one of the biggest areas that needs to be adapted. So how do you see cities shaping up in the drive for sustainability?
I think it's really fascinating, because I actually think what the pandemic's done is I think it's given people the freedom to question and to innovate in so many different ways. Not just innovate in the way they're working and shopping and living their lives, but actually for cities to go, well, actually, is the way we've planned the city the best way? Was it right that we spent a huge proportion of our wealth moving people around every day just to perform fairly routine tasks? And I do think that sense of everything's now again open for question, that sort of post-war consensus about perhaps how we planned and organized our cities is now open for question once again. Whether we go right round in a loop and come back to just doing exactly what we did before is clearly quite possible. But it feels like there's a moment where it is one of those big shifts, and people think again about how we live. But I think that flight to country, that interest in green, that interest in fresh air, that interest in cycling, enjoying open space, the cleanliness of our city, the health of our city, I don't think those are going away. And I think that is now going to be firmly embedded in how we plan, think, design our cities in the future. I think it was always there. I think that was always a product of 19th century city building, as it was in the immediate post-war period. But I think it just takes on a whole new meaning for people. I think that sense of the 15-minute city isn't just a sort of cozy reminder of how it was in the early pandemic, where I could walk to my local baker or my local shop and get everything I needed to live on. I think it's a kind of a recognition that, yes, I can be part of a big conurbation or a big city, but I need to have my day-to-day existence in a sensible distance where I can walk and cycle and get all the fresh air and access to open space that I really need. And I think that idea of I don't have to travel a huge distance for everything. I don't have to spend 2 hours sitting in a train every day. I don't have to spend 2.5 hours sitting every day in a car, moving backwards and forwards between really what are simple day-to-day tasks. And the idea that can I create cities that have more a more kind of better link really between the way my home life is and the way my work life is, and equally, how do I make sure they don't totally converge on one another and I end up working all day and all night. So again, I think people need separation, but I think they're kind of craving more convenience really and more time back. But I think yeah, I think it's been an extraordinary time for how we think about cities. I don't think they're going away. There's not room in the countryside for us all. And actually, I think you see the busy times now in most cities are the evenings and weekends. And I think some of the highest patronage on metro systems is actually now the weekend, which again is a kind of total reversal of the way it used to be. But people are still wanting to come into cities to access art galleries, theatres, cinemas, restaurants, and meet with one another. But they also want and are craving access to open space. People loved dining in the street, curiously, and I don't think a lot of people, I think people are quite sad to see that disappear as it has already started to in certain places.
Yeah, I definitely knowing me, I think that was quite an enjoyable thing, particularly over the summer months. Maybe not so enjoyable over the winter here in the UK,
Sure.
particularly.
Yeah.
Just picking up on a question here, and Christine, are there any regional variations and nuances that you've noted in terms of property appetite, particularly across Asia Pacific?
Sure. I think this pandemic is evolving and it has certainly continued to redefine our attitude towards risk. Although there are clear signs of recovery, but this emergence of Delta variant actually means things could be unpredictable. So to weather such uncertainties, I think wealth preservation will be a key strategy as a reflection of this. And exposure to prime residential properties, especially in core gateway markets, are increasing. And we're seeing diversification also being another concern, which will lead to more capital flows into alternative sectors. So our pandemic has caused all these trends to accelerate. And also, with heightened ESG awareness, the other guests actually alluded to earlier, amongst investors, is the growing allocation to this ESG agenda. It's going to be a long-term trend, and the impact of this really is on the regulations as well as valuations placed on ESG compliance. I think that will be the key drivers going forward. But from the regional perspective, it's really the wealthy and also the younger cohort. How they're prioritizing the responsibilities to environment and society, and that's going to impact the real estate investments going forward.
Yeah, I mean, there's certainly so much to think about, and there's so many different overlapping themes that are all linked together. But I'm afraid that is all we have time for at the moment. But I want to thank once again my brilliant panel for joining me. The insight has been invaluable. I know I certainly appreciate it, and hope the audience do too. I just want to say, please do take the attitude survey, which the link is in the related contents box. We'd love to hear from you if you have any ultra high net worth clients and it's your turn to be part of the Wealth Report 2022. And also, if you haven't already signed up for the next in our webinar series, we have a webinar hosted by the report's editor, Andrew Shirley, on luxury investments and investments of passion coming up next month. But thank you once again for joining us, and thank you to my panel, and I hope you have a wonderful day.
Thank you, Flora.